Hello and welcome to Solution Loans. This short video covers a guide to homeowner loans. Homeowner loans open up the opportunity to borrow much larger amounts of money at a lower interest rate than other forms of lending. They do this by using a borrower's home as security. Therefore, they're a secured loan. Loan amounts vary considerably, but many lenders will offer homeowner loans of between £5,000 and £250,000, depending upon the market value of a house and how much equity there is. Compared with personal loans, choosing a homeowner loan could be a sensible choice, particularly when most banks will only offer personal loans of up to £15,000. Because the loan is backed by a property as security, homeowner loans are available to many people with lower credit ratings and interest rates are lower. There are also much longer repayment schedules available. Homeowner loans are otherwise known as second mortgages or second charge loans because the borrower must already have a mortgage on their own property. They are not available to people who own their home outright who should consider remortgaging if they want to borrow large sums. Homeowner loans are more complicated forms of finance than personal loans because of the use of a property as security. As a result, they take longer to set up than any other form of finance with the exception of mortgages. So, how exactly does a homeowner loan work? A homeowner loan gives a buyer access to much larger sums than a typical unsecured loan. Even if you have a poor credit rating, including defaults, CCJs or mortgage arrears, you may still be able to apply for a homeowner loan and take advantage of a more competitive interest rates than other forms of lending. You can stretch your repayments out over much longer periods with a homeowner loan, sometimes as much as 25 years, and you'll also be able to plan your finances over the long term accordingly. How much you'll be able to borrow depends on, among other criteria, the loan to value of the loan, known as the LTV. The LTV is the maximum lending value of the financial product as a ratio of the secured property's value. So, if the LTV of a loan is 50% and a home is valued at £300,000, then the maximum amount of a loan available would be £150,000. Different lenders offer different ranges of homeowner loans with different maximum LTVs. Those with higher LTVs tend to charge higher APR. This is because, should the property prices fall, there's a greater risk that the lender won't be able to recover the full loan amount if a borrower isn't able to keep up with repayments. So, why would you apply for a homeowner loan? If you've got a less than perfect credit rating, are self-employed, or have recently changed job and don't have 3 months of pay slips, you may find it difficult to borrow significant amounts of money through personal lending. A homeowner loan could give you access to a large lump sum to fund some home improvements, to buy a new car, have an extension, or consolidate other debts. If you have a reasonable amount of equity in your home and you have an existing mortgage, then a homeowner loan could provide you with a relatively low interest sum with a repayment period to suit your lifestyle. So, what are the downsides with a homeowner loan? As with other forms of lending, the amount you can borrow with a homeowner loan will depend greatly on your income and your credit score and your existing financial commitments. On top of this, it will depend on the amount of equity you have in your home. Although a lender's headline figure may suggest that you can borrow a six-figure sum, the actual amount may be much smaller if your home's value has not risen much since you bought it. The biggest risk with a homeowner loan is that you could find your house being repossessed if you don't keep up with repayments. And bear in mind that should this happen, you could be liable for any shortfall between the sale price and the outstanding amounts of both your mortgage and your homeowner loan. So, in conclusion, homeowner loans can provide a borrower with much larger sums than personal loans at a relatively low interest rate. You can choose to repay the loan over a longer period, up to 25 years, meaning that it could be much easier to plan your repayments. If you have a poor credit history or you don't have a long record of employment with the same employer, a homeowner loan could provide you with the means to make the home improvements you've been seeking to fund.